Mark, was the response overnight in Asia a bit of an overreaction? It was a nearly 3 sigma move, standard deviation move in the Shanghai comp. It was a big move.
Well, thank you. And I think you have to put really this whole week of art of the deal style geopolitics in perspective when you look at these market reactions. You know, it's not just the tariff announcements from the U.S. side. I think my favorite quote of the week is from the Chinese ambassador, who said, if somebody imposes a trade war on China, we'll fight to the end. Not exactly what anybody wants to hear. And then, of course, as you've mentioned, we have John Bolton's appointment as National Security Advisor, famous to stop Iran's bomb Iran, and comments on North Korea. Additionally, we had Fed Chair Powell tell us, well, the Fed forecasting is not worth so much as you get further out into the future. And of course, the U.S. Congress passed its $1.3 trillion spending bill. So there's a lot of rhetoric that's been put into this market this week, and I think that's part of the response that we're seeing. But for us, it's still too early to give up on this global growth story because we're only in phase 1 of this protectionist story.
Okay, it's interesting. So cyclicals are really bearing the brunt of it in Europe this morning. So that growth story is being priced out a little bit, and you see it in the commodity space as well. You see it in the iron ore story, this kind of sense that maybe the headwinds to growth are just beginning to mount a little bit more. How much do I sit in cash right now and look to sort of weather it that way and therefore provide myself with some opportunities if this blows over? How do I make this work from a portfolio point of view?
That's a great question, and I think that we're not sitting in cash. I don't want to minimize the potential difficulties that a wider trade war, an actual trade war, could create, and we put the risk of that maybe at 20 to 30% right now. But what we've done is added some kind of counter-cyclical positions to our portfolio that would be overweight the 10-year U.S. Treasury, overweight the yen versus the New Zealand dollar, and have some put protection in some of the major indexes to kind of balance what we see as a much more volatile year, even if our base case, which is a growth story, continues to play out.